One fund on point for today, the expert to talk about it. Welcome to the ETF of the week. Yes, this is the ETF of the week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with the help of Todd Rosenbluth. He's the head of research at VettaFi. And VettaFi.com, their website, has all the tools you need to make yourself a better, smarter, savvier investor in ETFs. Todd Rosenbluth, great to chat with you again. Your ETF of the week is
the VictoryShares Free Cash Flow Growth ETF, GFLW.
GFLW, VictoryShares Free Cash Flow Growth ETF. So a couple of things that we don't always see in names, like, yes, you have growth there, but free cash flow, that's a distinctive style. So explain what it is that you're looking for and why this fund now.
So this is a quality growth ETF. I tend to think of free cash flow as a wonderful metric to assess high quality in a company, because if you've got strong free cash flow and it's growing, that's a positive sign. This ETF from VictoryShares came to market at the end of 2024. And it's one of those funds that's doing quite well in that it's gathering assets this year, doing quite well, and it's actually outperforming the traditional growth benchmark of the Russell 1000 growth this year in an environment where high growth is in a priority. I think we're going to see a bit more volatility in 2026. I think we all expected we were going to have more of it, but I think we're going to see more of it to actually occur in 2026. And so for people who are looking for a growth strategy, this is a factor-focused, smarter way of investing in growth, in my opinion.
It's a fund that it has done very well this year. It's up more than 20%, which is a couple of percentage points ahead of the category. What is it doing to generate that kind of performance that puts it in the top quartile of its peer group?
So this takes a look at growth companies and assesses them based on their free cash flow generation, both a forward-looking and a backward-looking approach. That's, I think, different than some of the other quality metrics, quality-based ETFs that are out there that only look backward. This takes a forward-looking approach. Now, with a growth ETF, you'd expect to find technology stocks, and you will find in here. But I noticed when we're looking relative to the Russell 1000 growth that this is slightly underweight towards technology stocks, but it's overweighted towards healthcare and industrial companies as we're talking right now in mid-December or early to mid-December. Now, this is an ETF that rebalances periodically. In fact, VettaFi is an index partner with VictoryShares in support of this. But what caught my eye is this fund has gathered over $500 million of assets this year. It's now up to $650 million. That's particularly compelling. I know you and I have talked a lot about active ETFs this year and the growth of active ETFs. This, to me, is a good example of there's still demand for an index-based strategy.
And at the same time, it is an index-based strategy that does include a couple of the biggest names, which is not a big surprise. You can't really have a large growth fund and not have NVIDIA and Alphabet and a couple of other names like that in the portfolio. So large growth is the category where almost everybody, whatever your first mutual fund is, et cetera, large growth there's a good chance that's where people have stuff. So if people are going to look at this fund, we know they have the category. They may not have the allocation mix. If you've already got one growth fund, is it the style that gives you the diversification here and it's worth adding a little bit of portfolio complexity to do it? Or is there something else that's going to drive that investment decision?
So we've seen, I believe what we've seen is that investors are using this as a complement to their growth strategy, either to reduce that concentration risk or just because this might be a better way of doing it. Let me stay on that concentration risk. You're right. NVIDIA and Alphabet are the two largest holdings at the most recent look at it, but they're roughly 4% each of the portfolio. And that's intentional because the index has a capping component to it. And so as I look through the top 10 holdings or recent top 10 holdings, I see Booking holding. I see DoorDash, I see Spotify Technology, Palantir. These are all companies, growth companies people have heard of, but you won't find the same exposure, 2 to 4% exposure to these companies in a Russell 1000 or even a NASDAQ 100 market cap weighted approach, which is dominated by those Mag 7 stocks. So I think people are using this VictoryShares ETF, GFLW, to diversify away from the mega cap companies, have some exposure, but not have all of their eggs in that basket because those stocks won't go up forever.
Expense ratio on this is 39 basis points, 0.39%. And I'm curious there because we've talked a lot about expense ratios. And I know that it's not a big determining factor as long as it doesn't get, too high or what have you. But I'm old enough to remember when 39 basis points would have been a big bargain on an actively managed large cap growth fund. Of course, the ETF revolution changed that and has made it that, 39 basis points, not bad, not the best for you. And this is not a question I've ever really asked you. Is there a level where you go, hey, this is really expensive for an ETF in a big category like this? And below, like, is there a level where you look and say, for what I'm getting on an actively managed ETF that's buying domestic stocks and not doing something that's particularly tricky, I want to see an expense ratio below this because anything above it strikes me as costly.
So I think if you're investing in a market cap weighted approach, which is just simple and I guess a crude way of doing it, there's nothing wrong with it. That's just a simple way of doing it. You're going to find strategies that are 10 basis points or less. I think actually the Russell 1000 growth ETFs might be a little bit higher. Certainly the iShares one that is the largest of those products. With active or even in this case, index-based, but factor, where it rebalances a couple of times throughout the year as a result of a look at quality growth metrics. I think 39 basis points is reasonable, but to me, an expense ratio is one of those things on your checklist when you're comparing ETFs. And so if you look at the performance of this fund in the, albeit short 1 year time period, it has outperformed, I believe, the iShares Russell 1000 growth ETF, despite being slightly more expensive. So if that's certainly a positive thing, and then you'd want to look at some of the other characteristics as we talked about. It's not as concentrated. You get exposure to not just technology stocks within a growth ETF. Those are all those things I would want to consider when I'm looking at an ETF, and I hope that investors and advisors are doing so also. Not just buying the cheapest ETF, but finding the best ETF for them.
Sometimes when we're looking at a fund, you're looking at it as something you add to the portfolio as a long-term holding. Sometimes it's tactical. This smells to me like this is long-term. You'd want to do this for that diversification of your large cap side of thing if you need some of that. But is this tactical or is this that long-term hold?
So I think this is a strategic position to be able to have as a complement to your existing large cap growth or large cap oriented ETF that is tilted towards growth because it's concentrated. I don't know that I have strong enough views, but heading into the year, many people are optimistic and are leaning towards some of those growth companies to continue to head higher with consciousness from a valuation standpoint. So this could be a tactical move as you start the year and we see if the moderately bullish mindset continues. And if that isn't the case, then you might want to dial this back. There are other ETFs that offer a quality approach, but are not as growth oriented. In fact, I'd be remiss. We talked about one of those from Victory, the VFLO. VFLO is the more value oriented brother, sister, cousin of GFLW. You could be able to rotate between those two ETFs depending upon growth versus value.
And that would be an interesting way to play it. But this is an interesting pick as a potential add to a portfolio. It's GFLW, GFLO, the VictoryShares Free Cash Flow Growth ETF. The ETF of the week from Todd Rosenbluth at VettaFi. Todd, great stuff. See you again next week.
Thanks a lot, Chuck. You too.
The ETF of the week is a joint production of VettaFi and Moneylife with Chuck Jaffe. And I'm Chuck Jaffe, and I'd love it if you check out my hour-long weekday podcast by going to MoneyLifeShow.com or by searching for it wherever you find your favorite podcasts. Now, if you're searching for information on your favorite ETFs, or maybe something we talk about here that could be your next favorite ETF, there's no better place to go looking for information than VettaFi.com, where they've got a full suite of details and information that'll help you out. They're on X at Vetta_Fi. Todd Rosenbluth, their head of research, my guest, he's on X too, at Todd Rosenbluth. The ETF of the week is here for you every Thursday. Make sure you don't miss an episode by following along on your favorite podcast app. And we'll be back with another ETF for you to consider again next week. But until then, happy investing, everybody.